Hey guys, Heston and Brian here from McGrath Estate Agent. We're joined today by Ryan Baddock, the owner of RB Finance, or commonly known as Bads, we like to call him. Look, we're just here to pretty much have a discussion with him about his business and where he sort of sees the market going financially. So
thanks for having me, guys. Yeah, and it's awesome to see you guys bring the brand into town and what you're doing, and really I appreciate the opportunity to have a chat.
Thank you. We appreciate it as well.
Yeah.
Tell us a little bit about yourself, Bads, and how you come to RB, a little bit about your history for people who might not know. So
I kicked off in the banking industry back in 2003 down in Victoria. My background's all been in commercial and ag, lending through banks. Moved up to Toowoomba and changed into another bank up here, so a couple of major banks, and then sort of round about 2016 just realised I wasn't going to stay banking for the rest of my life. I didn't want to keep in that role, and I could potentially help a lot more people doing it, in our own way and as a broker. And thought I always had a burning desire to sort of be self-employed and work for myself and build something for our family. And that's how I grew up as well, on a family farm, and parents with family businesses and stuff. So that was my skill set. So natural progression into broking. 2017. Just started out, ran the first 12 months by myself, then just gradually employed staff, and we're up to 6 people now. I thought that I would just be doing commercial transactions, quickly realised that everyone that has a commercial business also has a home loan. It was a baptism of fire with home loans, because in the commercial world someone would be processing them for you. So, got onto that, but found it super rewarding to be doing those, the home lending and just the volume of transactions and helping everyday people. We still do heaps of the commercial work as well, but it's that's the kind of progression that we've taken, and I love getting in and adding some real value and bringing some technical skill to the home lending space, which is a lot more than just ticking boxes, basically.
Cool. What's the I know it's probably a little bit taboo talking about it, but sort of doctors versus chiropractors, you've got mortgage brokers versus bankers, and you're saying your background's banking. I guess for people that always ask me through my career, do we see a broker, do we see a banker? You've been in both sides.
Yep.
What's your honest opinion of bankers versus brokers, and why you'd go either or direction?
Yeah, look, so when you're working in a bank, you can only sell your product at your bank. So if I'm working at bank A, and I know full well that bank C is going to be a better bank for them for the client, because of their policy or because of their pricing or what have you, I'm not about to go and say, hey, for this deal you should go and see bank C, and then hopefully come back to me for your next deal. So the key difference is that we will recommend the bank out of the panel. We've got 50 odd lenders that we use across the board. So being able to genuinely pair up our clients, and not just the clients on an individual client basis, but sometimes on an individual transaction basis, and go, this bank is going to be the best for that transaction, for that asset, or this bank's going to better suit your circumstance, or using a stepping stone of, this bank will get you started, we'll build a track record, their policy procedure allows you to start, we'll build up, and then we'll move to more mainstream funding if that's the case. So the key difference is choice, and being able to really tailor things. The other thing is, working in a bank, there's a lot of tricks, and they're trying to make money, obviously, for shareholders. And what we're trying to do from the outside is make sure that, the big banks are going to still make their $8 to $10 billion a year, regardless of what each person does individually. So if we can maximise that benefit and be saving a borrower 10 grand a year or 100 grand a year on structure and interest rate, we're ringing our clients every 12 months and telling them, hey, we've just managed to renegotiate your deal. The bank doesn't ring you up and say, hey, I've just reduced your interest rate. The bank doesn't say, hey, I just want to reduce my margin. That's not what they do. So on a proactive basis, we're managing that. So that's it's sort of, I think, the two key benefits. Yeah. And I think from our point of view, bank managers in commercial lending, they're basically bank managers working for the bank. And from our side of things, we're kind of, with that skill, the bank managers that are genuinely working for the client. And on the home loan space, there's so much automation and ticking and flicking, and if you put the wrong tick in the wrong box, you can blow your application up. So it can appear to be simple, but there's a lot of traps that you can navigate through. And a lot of dealing with us, I think I'm stealing this quote, but it's basically like a dress rehearsal. You come to us, we we iron out all the kinks, and then when we go to the bank opening night, pull back the curtains, and it's a proper performance, and we get it done.
Yeah. Cool.
Love it. So I think that's the key difference what you were talking about there, and just as people that deal in real estate where they start out on a journey of buying one property, but they're going to buy a lot of properties over their transaction over the years, and I think that's where you get that diversity of experience where if they're doing residential, they're doing commercial, they're doing a bit of agri, a bit of financing or whatever they're trying to achieve, you can pretty much take them on that journey. They don't have to go to a bank and then they have to go to a different bank and get a different relationship.
Yeah. So it's a consistent relationship. Yeah. And like we talked about, you can't, it's very difficult to have a relationship as an individual with an organisation. The organisation is not going to have that loyalty back to you. Absolutely. And so, and we know that a lot of bankers, to progress in their career, they have to move jobs, unfortunately, and I've been there. And that then means that they have to, unfortunately, leave their clients behind, or if you go back into the branch, you know, you have to, currently you've got to make an appointment 2 weeks out to open a bank account, you know. So it's a frustrating experience whereby if we can navigate those things and help build that relationship, and clients can ring and say, hey, I'm just thinking about this, or, you know, they're at an open, I can't remember what you said, I could borrow, they give us a ring Saturday morning, we answer the phone, it's like, yeah, you're up, you know, you're right to go, that type of thing. It just means that they've got that, you know, comfort and they feel confident in what they're doing, as opposed to potentially a less experienced banker in the branch that doesn't necessarily understand some of the complex transactions. I mean, banking, just like you guys, it's easy when it's easy, but it's pretty hard when it's not. So, yeah.
Well, they all stay inside their box, so they're not going to really jump out of the thing. I do residential, I don't do commercial. It's like, I think that's where, to me, that's the greatest thing. You've got that conduit, you maintain that relationship, you're not having to re-explain yourself. Every time you have to go back out and do another fund or another purchase, another acquisition, it's like, oh, I have to go tell this guy, new guy, everything I've already just told the last guy. You become the conduit, and that's your problem. Love that. So other than that, I mean, how are you finding the market shuffling at the moment, like starting in 2024 compared to 2023?
Yeah, interesting times. I mean, obviously interest rates is a hot topic at the moment, and I think towards the end of last year, a lot of people run out of steam, and a few rate rises, and just probably more than was required. It really did take a bit of sting out of the market, but we're seeing a lot of people coming back in, and we're seeing a lot of still refinance activity. Interestingly, still seeing a lot of first home buyers still trying to work out where they can go, and obviously as rents continue to increase, then they're looking at what they can do to help get themselves into the market. The turnaround times from banks have improved a lot in the mortgage side, in the home lending side. Commercial side, it's still pretty clunky, but yeah, things are going pretty well. There's a merger with Suncorp and ANZ locally here, not locally, but Queensland's probably more affected than a lot of other states, and that's sort of interesting. Suncorp, one of the next after the big four, and is obviously going to reduce competition, so it just further strengthens what we do. But it's an interesting market. I think there's plenty of opportunity, and you guys know the property values and demand. I was talking to a buyer yesterday. He's gone multi-offer, and I think there were 6 offers on a 500 odd house. So there's still plenty of demand, and the borrowers are only able to get themselves in those positions because they're organised and prepared. So
there's no doubt there's still a scarcity in the market. There mightn't be as much stock out there, there's not enough stock, as sort of scarcity is, but there's a reduced amount of buyers, no doubt. Quality of buyers still there for the amount of properties. So from our perspective, it's still very busy if you've got stock.
Strange with cost of living too, because even though cost of living hasn't come down, people are still spending money, and now they're not complaining about it as much, but it still hasn't come down. And people are still shopping,
coffee shops are still busy. Foods, you go out to lunch, there's still plenty of people having lunch, so people are still spending money.
Well, I think there's definitely difficulty in the economy at the minute, and unfortunately that's how it works. It has to be like that for the way the economic situation is with the rising interest rates to control inflation. There has to be some pain, and that's unfortunate. But broadly speaking, and typically, especially in Australia, people will pay their mortgage. That's one of the fortunate things, and that's why our banking system's so strong. So,
but I think that's where back to where we started, where I think the reality of using a bloke like yourself that that diversity of experience and understanding where you can save money. And we do the same thing with property management, and we're dealing with landlords where we're really managing the individual, their needs and what they're trying to do. If they're trying to send kids through school, how do we help them save money in their day-to-day costs of running an investment property or a commercial property or whatever else? And that's where we step in and look at the fundamentals of the property, and then we use guys like yourself where you can look at the funding and say, how do we save a couple $100 a month, which is going to be a lot better in their back pocket than the banks. And effectively, that's what we love to see.
Yeah, we had an example last year, I think it was, maybe early last year, where a client came and said, look, we're just going through a really expensive period with our kids. The cost of living is getting tough. We're going to sell the investment property, and then we need to refinance our home loan. And that's what they came and said they want to do. And we looked at it and said, well, what about if we free up some cash? We can potentially restructure lending so that the repayments are more in line with what they can currently achieve, give them some capacity to cover the next few years, and they've been able to keep their investment property. Like that's a $600,000-700,000 investment property in a good part of Toowoomba that you guys know has gone up 10 or 15%. So they've managed to preserve $100,000 worth of equity rather than selling it.
Well, in effect, they've preserved the original $100,000 of equity, but now they've got $400,000 of equity in that property. So just in growth.
So getting the structure right is critical and often more important than the outright interest rate, for example. And the critical thing to remember for people like that is just because that's the deal you got at the start, it's not the deal you have to stay on for the rest of your life. It's not a set and forget thing, and that's where people fall into the trap of 30-year home loan. I've got everything set up, I don't have to think about it again, but that's going to be your biggest expense. People review, you shop around for the cheapest fuel when you're spending $60. So, but you don't look at your home loan.
I think that's where a lot of people fall down. We see it quite often where they're trying to focus on the rent, the very big ticket items where they're looking at that. I want to increase the rent, it's the only way I make money, rather than actually look at there's other ways to actually improve the property value. Chase the capital value, of course, but improve the loan. Move it around, don't leave it at one bank. Why?
Sure.
But I think we get comfortable. People don't want to actually bother, they don't want to go back to the bank. And they don't want the hassle of going to a broker sometimes.
They're also confused too. Half the time when we talk to clients, they just don't know exactly the way to go about it. And then, even when they see us, there's people that don't offer them advice that we offer them, and they don't think there's another way around it. So,
We don't know what you don't know, really, do you? And you're also nervous about, I don't know what you guys do properly. I don't know what, all the professionals necessarily do in the ins and outs. But
you see that's a problem in the industries that we have this diversity of industries. We have, the finance sector, the real estate market, then we've got, some developers over this side, builders over this side, but really there's no communication channel that actually brings it all together. So a conduit that actually helps out and vertically integrates through businesses.
Putting things together. I think just building the right people around your transactions is critical,
Yeah, I think that, from where we sort of move with the brand and with McGrath, I suppose we're more moving towards that factor of having an asset manager or an individual that actually helps to be that dot connector, to actually maintain those relationships with guys like yourself, to actually ensure that we can actually put people on a pathway to ensure they're doing the right things with their property as much as we possibly can.
We'll have the foresight to see that, if the dishwasher is going to be playing up in a few months, then they're well aware of it, so they start working out a plan to save for it rather than getting slapped with a bill at the, when it blows up and they can't afford it, and then it has to be reduced through the rent, and so it's not a property manager like Brian said, it's an asset manager. So it's someone we want to implement. So.
Absolutely.
How do you find? I've just been asked a few questions first-time buyers that are renting currently who are paying huge amounts of rent. They're struggling to save money, obviously, to get a deposit. What's your sort of advice around that? With people trying to get into the market, they can't use parents as guarantor or extra bit of cash. What do you do in that situation?
So there's a couple. You touched on parents as a guarantor is one strategy if that's an option. If that's not an option, you've got the home guarantee scheme, so where the clients can get in with a 5% deposit plus a couple of grand for costs, solicitors and a few transfer fees and things. That's a real big one to get people in. We've got people on savings plans at the moment just to try and help them push through. I suppose the schemes Some people we've topped up with, you can top up with a personal loan if it's going to reduce the amount of mortgage insurance you pay, that type of stuff.
Yeah.
It's also about understanding the bank's policies. If you're in a professional role, a number of professionals can leverage higher lending ratios without paying mortgage insurance, that sort of stuff. Yeah. Just basically looking, at some point in time, one of two things is going to limit the borrowing capacity. It's either going to be the size of their deposit or the income relative to their expenses. Yeah. And so if they've got, a number of credit cards and a couple of car loans and that sort of stuff, we'll sit down and work out, well, you might have a 35 grand deposit and you've got truckloads of consumer debt over here. Yeah. So, but if you've got a really good income, then that could be enough. But if it's the size of your deposit isn't there, you sort of work out whether or not they should or shouldn't be clearing the debt. Because sometimes you clear the personal debt, boost your borrowing capacity, but then you don't have a big enough deposit. So we've just got to sit down and work out what's the right way forward. And obviously if you go and pay out a car loan and then you go to buy a house and they're like, oh, you're 5 grand short, and I shouldn't have paid out my car loan. You can't go back to the bank and say, can I have that 5 grand back? So it's about planning and working out what is the key step that's going to get me to the next part without making an error that I can't undo. So just planning and structuring, and we often sit down, particularly with first home buyers. They'll come in, we're just looking, we're just starting, what can we borrow, and we'll work out what their income allows them to borrow. And then I'll say, righto, if you're going to get that $500,000 house, you need 30 grand. How much are you saving a fortnight? Let's work through that, and we'll check in 6 months' time and go from there. The personal loan thing's a bit contentious because obviously, you're buying a long-term asset with short-term finance. But in the instance where property values are increasing, sometimes people just can't save quick enough. So you might be saving 5 grand a month. The property value is 5 grand a month, and in relative terms, you're not getting anywhere. So at least if you can get into the market, then keep riding the value up, then restructure and get rid of the personal loan, then that's an option.
Well, I think that's where, if you can get the people to actually look at the property market, they should be in for where they are today, not trying to buy into a market where they think they're going to be, in 10 years, and they're trying to buy it today. So I think that's what we try to find is be strategic, put people on a pathway, make sure they get into the market, but accept where you are, and let that market growth help you to capitalise down the track and buy into another house in 3 years' time.
Your first house isn't your last house.
100%.
So, and I think if you could buy, as a first home buyer, if I could do it again, I would buy an investment property. Like I would live in it, but I would be looking for an investment property to live in for 12 months. So that when I then buy my next house, that becomes an investment, and then just grow the portfolio from there, rather than trying to buy my nice cottage or something somewhere that's not going to be the right investment property.
I was telling Heston, I had a call from clients of mine about just over a month ago now. They were both teachers. They went to buy their first home, and this was probably 17 years ago. They now have 7 properties now. From that original investment. So rather than buy a first home, they actually bought their first investment, stayed with mum and dad. They rang me literally a month ago just to say that they're still going well. They actually own all those houses, no doubt. And that's in 17 years. And all because they bought that first investment property rather than buying a first home.
Long game.
Interesting. 6 properties now. They're basically both teachers. Debt free. Don't really care too much at all. All started 17 years ago. So one decision.
Well, I sold an investment property once, and I kind of regret it.
Well, I think there's no right. I think the thing is, I think we sort of look at it with what we deal with. We get people come in and they've got all these strategies, read all these different books, but there's 10 pathways to make a lot of money and wealth through real estate. They all work. Just pick one. I think too many people drop between. They're sort of keeping one, they're selling this one, they're flipping. They're just pick one. Pick a market, stay on it, believe in it. If you look at Margaret Lomas, still has the first property they had in 1972. Still owns it. Is it right or is it wrong? There's guys that have bought 400 properties. But at the end of the day, they're all in the same location. So I think that's where I think we try to. You can't put anybody in a box, but we try to work out where their circumstances lie and help them where we can. And then, as I said, the more we can work with a broker that can keep that conduit of relationship. Whatever bank's needed for their circumstances at this time. And that'll change in 2 years or in 6 months for the next property.
Definitely. What do you think over the changeovers, lads? So we've got a lot of people, because it's scarcity in the market, so we've got a lot of clients saying that, we'd rather find something to buy first and sell the home, which is a lot delayed, and, then you have to be subject to sale of that sort of thing. So in our world, less conditions is better, usually. For people looking to be a subject to sale, sell their home, and then get approval for finance on the home they're purchasing, are the resi contracts, sort of taking a fairly long, or are they quite reasonable in timing, or for the finance clauses?
Yeah, in that situation, yes, we'd be looking at more so bridging loans for clients. There's a couple of banks that do a pretty good job with a bridging loan, and they're not most people, as soon as they hear bridging loan, they start ducking for cover.
Double loans, double payments.
Yeah, it's not like they're not as bad as they kind of were, I suppose, and you still there's a few twists and turns in a bridging loan, and they can be a bit complex, but they're more and more popular in helping people get to that outcome. We're also looking at and setting it up so often we'll have a conversation with someone and say, well, what about if we treat your current home as an investment property, and then the new one as your owner-occupied property, and then if you buy this one, you've got rental income from this one potentially, you can then still keep it as an investment, or you can still sell it, but keep it for 6 months and see what happens. If you can afford it, you don't. Then maybe you'll go, okay, well, we'll keep it as an investment. So just giving them that flexibility. In terms of, but the contract terms, subject to sales and all those sorts of things, they're always a challenge. Especially if you get a bit of a line, 4 or 5 on the same day, how it goes. So
especially in this climate where you can't always be sure of the settlement on the other side, that we sometimes don't control.
Settlements are just hard to control. I mean, when I started working in the bank, I used to feel like you'd just about lose your job if you missed a settlement. Nowadays, it's a pretty loose guideline, and you've obviously got the 5-day clause in Queensland contracts now, which
it's ridiculous. That's
kind of just moved the settlement date back 5 days for some people. I mean, and we have part of the role in our office is making sure that settlement is right to go, and we're onto it, and making sure that we go through our settlements, every day, just to say what's coming, where are we at, what do we need to do to try and make sure they do settle. But it's a difficult thing to line up a settlement when you've got so many moving parts, and then it's just the people that do it, they're kind of just shuffling paper to a degree. There's no emotion in it, and then obviously PEXA can be a bit of a problem too, because everyone just blames everyone else without anyone really knowing what's going on. So
And I guess people that are listening that don't know that the clause that Baz was speaking about is that essentially the seller or buyer can elect to implement a 5-day clause after the effective settlement if they're not prepared for whatever reason. So they have to have a genuine reason, but you settle on the first, you've got all your moveless trucks ready, organised, you're getting moved out of your current home that you might be renting to move into this property, while on the day before, essentially the day of, the seller can exercise that clause, which means that it's delayed another 5 days. So, it makes it a little bit tricky. I've had it happen twice to me, but it's a little bit tricky. So.
I'm not sure I'd be just parked out the front with a removal truck on settlement day anymore.
Not anymore.
No.
Yeah, but that's bureaucracy making decisions that don't really look at the ramifications. There is practicality there, but I think that's where the communication should come in between lawyers. I think we lost that.
Yeah, and you can do it the day of. It's ridiculous.
You can build all those reliances in, where we generally have a discussion with buyers, about their circumstances, and if we think it's a bit of a tight settlement, we'll push it out to allow for them to actually have the room.
Yeah, I think ultimately making sure that the solicitor and the agents and if everyone's working to the same outcome, and if everyone's open around what's actually going on, then it's far easier for, say, a vendor to accept an extension if it is simply a matter of processing time. If it's a matter of the buyer not having any finance, or they're going around to their third bank or whatever, then that's not really that's a problem. But
that's where the agents have to step in and make sure we've pre-qualified. That's the size of the deposit. These days of $1,000 deposit or $20 deposits, those things should be well and truly gone. A decent deposit actually puts some skin in the game, and I think also, from our perspective, it's actually allowing it, saying don't rely on settlement on the Friday. If it's a 5-day, bank on the fact it'll be the following Friday. But move everything around that. If it happens earlier, removal trucks are the hardest thing. That's the frustration.
Especially kids packing your life.
But if they're purchasing another property or whatever, you just push it out to the following one. You have the funds in the bank, and then you have them one move. But yeah, I think we're just going to deal with that until they change it again, which they'll end up having.
Yeah,
I think.
definitely.
But I think practically, and if the conveyancers are communicating and providing that kind of, rather than just the doomsday or this, where this is going to fall over, this is done, right? Like everyone knows that when you want to get the outcome, the best outcome is still to get the contract completed. So yeah.
But I think we don't want to sort of change the whole thing based on a few transactions. Like for every 10, you may have one.
Yeah,
maybe.
And you may have none.
Maybe.
So it's pretty much 1 in 10 at best.
I just come back to communication. Like Bad said, everyone's got to be on the same team, same page.
Yeah.
So what else are you sort of finding? Where do you see the market spending? You're seeing people sort of delve into the commercial space, being concerned by the commercial space?
Commercial's interesting. People,
industrial, reluctant.
Yeah, like it's obviously, I think a lot of people seeing equity, they build equity in their home, and so they're looking at what can I do with that, or so they'll be looking at investment properties. They look at whether they should be doing commercial or residential investment. The challenge with a commercial investment is typically it's a bigger outlay to get started, and then it's potentially a lumpier cash flow, and so it's a harder thing to handle. We're seeing, there's a lot of people buying commercial premises for their own occupation, for their own businesses.
Yes.
So that's obviously something that's pretty popular at the moment. But I think they're two totally different things. Like a resi investment is a vastly different proposition to a commercial investment. I think you've got to have your eyes open and know what's coming and what is what's possible what can you handle, what's your risk level, and vacancy rates, and there's a number of vacancies around town at the moment. Yeah. So how do you manage those types of things?
If in doubt, stay out. That's probably the way to look at it. I think, research. The same as residential. Residential, you could probably make a bit of a slight error and get away with it.
Yeah.
Commercial, you make a slight error and you'd be in trouble. So,
or there's
definitely better research.
Peaks and troughs are just a bit higher, aren't they? So.
Well, you'll have a vacancy if you don't know what you're doing. If you don't know what the tenancy mix should be, you don't understand what the demographic is, and work out what the neighbouring properties are.
Yeah.
That can affect you. So you might have a grandeur, but then suddenly next door is a tattoo shop. Suddenly changes your whole outlook.
Makes it a challenge, yeah.
So anyway, other than that, what else are you finding in the marketplace that we should be looking at?
Look, I think people should just be actually looking at what's in the market rather than just accepting what they're being told. In banking and in finance, you get what you negotiate. You don't get what you deserve. So that's kind of a key thing, to make sure that you'll be able to present the most, or I suppose the strongest position, and understand. In a negotiation, it's handy to know what the other side needs. And where the value sits from both parties, and we do often. You'll be doing a transaction and you're just talking about an auction today. Like we've just got to tweak a little bit here. The bank wants this. How important is that to us? Just make sure you understand where your position, where your strengths are in the negotiation, and then manage your weaknesses. And go from there. I mean, every transaction, whether it be a resi or commercial deal, has a weakness. You've just got to understand what it is and how big a weakness that is in the eyes of the bank. And then ultimately, our job and the borrower's job is to manage that weakness so that the bank still takes the risk. I mean, that's why they charge you interest, because they're taking a risk.
100%.
So if you approach it with a commercial mindset that the bank in theory is taking a risk on me, the lower the risk they perceive, the better pricing is going to be and the better terms I'm going to get. And so making sure that you've got your ducks in a row and you understand what's going on, that's probably a key thing. I think being prepared, people making sure that they're prepared for applications or for the next thing, and not, often we'll talk to people that have just gone and done something. They might have bought a new car or something else that's impacted on what their borrowing capacity might have been. And if they had have changed the order in which they've done it, or just slightly, changed a couple of different things, then they could still achieve both. But if you do it in the wrong order, then you're not going to get the outcomes that you want. So being prepared, planning, asking questions of your bank. The lending environment is pretty, what they say, termed flat. So lending growth is not as steep as it was, particularly in the last couple of years. So there's a lot more competition for borrowers at the moment. So asking questions of your bank is the best you can do. Can you help me? If you don't have time to do that, or if you don't understand how to do that, then going and seeing a broker and getting that help to negotiate the pricing and make sure you're looking after yourself. But ultimately looking after yourself when it comes to dealing with the bank, because like I said, the bank's going to make $8 billion regardless of what you do. So make sure you're doing the best you can. Yeah.
100%.
Yeah.
Options. Can they get pre-approval? How certain can
Options,
they? Yeah. Everyone says, I don't have finance approval, but we want to buy this house at auction. We're going to go along. If it gets past then, we're going to try and buy it. Is there a way to get them to be able to bid on the day if they are subject to finance?
So pre-approvals they're interesting because some banks don't assess pre-approvals. So basically what they do is you put the information in. So I put in that I earn $80,000 a year and my partner earns $60,000 a year, and we've got a $100,000 deposit and we want to buy a $500,000 house. And if you put those numbers into the system and press the button and the bank comes back and goes, yeah, well that adds up, and you've got enough deposit and you don't have a bad credit file, because that's the only thing that's flagged out, they'll approve it as a conditional approval. That's without anyone checking that you actually do own $80,000, you haven't messed up your numbers, or there isn't some other hairy thing in somewhere that's made it go completely wrong. And so you can get a pre-approval in about 30 seconds. Yeah. And it can be not worth the paper it's written on. So making sure that if you're going to get a pre-approval, you get it from a bank that does a fully assessed pre-approval. Okay. We do more work than a lot like the banks do in getting ready for a pre-approval than they do in assessing a pre-approval. So having a correct and full conversation around what is your income, where's your variability. If you've got overtime or bonuses or commissions, or you haven't been in your role that long, or you have a lower deposit, or you're self-employed, they're all the things that are going to trip you up and mean that your pre-approval needs to be accurately assessed. Yeah. Because we've had situations where clients have had a pre-approval from a bank, just plucking numbers, but say you're approved to 500, go and buy a house, go back to the bank, I bought the house, they're like, oh yeah, we've just done the application, your borrowing capacity is actually 300. Oh, sorry about that, but go to a different bank who's the right bank for that lender, and you're back on track. So I think it's just making sure that you're getting the pre-approval, or the correct and assessed pre-approval, and getting it from the right bank. In terms of a pre-approval, in theory, the only thing that should be left outstanding after a pre-approval is evaluation. Yeah. And so the auction process then determines the valuation. As we know, the best way to tell what it's worth is to sell it in an auction. So that valuation is typically stacked to that level. Yeah. There is a risk that the valuation won't come up to the auction price, but I haven't seen that happen for a long time. And so just being aware of that, the valuation is probably the only key concern.
There's still an aspect of risk.
There is an aspect of risk, but that you can control as much as you can control. Yeah. And then it's important to make sure that you've done your due diligence on the asset. So if you've got whenever you've got a lower deposit, the bank's leaning more heavily on the security. And so then they'll be more particular about the property. If it's within a certain distance of a high voltage power line, for example, and then everything might stack up, but then the mortgage insurer won't insure it, then it's not going to work. Or if you're using a lender that is more particular around risk scores in the valuation, you've got a pre-approval at a bank that won't accept a higher risk score. And there's 10 risk scores in a valuation. If one of them is a bit higher, and that's a critical one for that bank, they won't take the deal in a mortgage insurance territory. Yeah. So you need to make sure you've matched the bank with your circumstance, but also the asset if that's required. And then you're managing as much of the risk as you can. Yeah. Cool. It absolutely can be done. Yeah. And I think tips for auctions is go to a few of them. Go and watch.
Stress out.
Yeah. But just go and watch get a feel for what's going on. It's a pretty daunting process. It happens pretty fast. It's like trying to.
But are you finding? I think the biggest thing is the misconception out there. I believe is people are more knowledgeable these days. And the thing is, we all think we are. We research a lot, but there's so much information out there. We even see it in property, where you look at properties and I can't even disseminate why people are selling for that price compared to that price. Yeah. Some houses just don't make sense. So I don't know how, as a buyer or a seller, look at the market and go, It's confusing. So as a buyer, you're walking in, you're seeing these auctions, a lot of times you've got to just experience the taste. Go to a few, just taste the market, experience it for a month or two to actually see where are the prices sitting. What am I willing to spend my money on? Because that's all that matters. If I've got $700,000, it really comes down to what I feel like spending money on. And if it feels right to me, it probably is, but I don't think you need to spend a couple of months of tasting that and seeing value. But the problem is in this market, there's so much scarcity. So it's tough.
Well,
so with market research, do you find that with the finance sector, people are coming in and just a little bit lost or more experienced?
Well, I think people are probably more experienced, but sometimes it can be dangerous to have half an idea. So then you think that you know more than you know, and then you start, it's like, I read a book on fixing my car, and then I start trying to pull my car apart, and I'm left over with a handful of bolts. That's the. So you've got to. You can understand, and it's handy to understand what's going on, but then still be aware that you haven't been doing it for 25 years. So that's the trap that people fall into. But
we've seen it in property. I mean, I've been around for 30 years in the game, and you see it where they think this is forever. I remember seeing back before 2008, I read an article, and this before I went over to the States, I remember watching it, and it said, the boom, you can't call it a boom if this is just the way the market is. Australia's just booming, and literally flew back in, and the country had fallen apart. So people just think, just because it is at the moment, it's going to be forever. And I think in the finance sector, it's chopping and changing. And at the moment, interest rates are coming down, but we don't know where the next war is and what are the next financial constraints that are going to happen in the marketplace. You can't forecast it. You just got to deal with where you're at.
Yeah, for sure. We find a lot of people that the bank will lend them more money than they're comfortable to repay. So conversation around, like you said, what do you think the house is worth? If you think it's worth 700 and you're happy with it being worth 700, then that's fine. And I'll say, if you're happy paying $1,000 a week, then happy days. If the bank might lend them a loan that's going to cost them $1,500 a week, but they're uncomfortable and it's going to keep them awake at night, then don't do it. Like, let's just, what do you want to pay? What do you want this house to cost you? Let's go.
And you might think you're happy with the pressure to start with, and then 3 months down the track, you're drowning, because you didn't account for maybe, council rates and all that other stuff that comes creeps in, and like anything, something blows up, or a dishwasher in your own home, you've got to replace that. So it's, there's unforeseen costs. So I definitely think that, don't overstretch yourself. Cool. Nice.
Awesome.
Good
to catch up.
Thanks, mate. Appreciate it. Thank you.
Thank you.
Well, mate.
Cheers, mate.
Good stuff.